Hello, in this lecture we will define acid-test ratio. According to Fundamental Accounting Principles, WILE 22nd edition, the definition of acid-test ratio is ratio used to assess a company's ability to settle its current debts with its most liquid assets, defined as quick assets, cash, short-term investments, and current receivables, divided by current liabilities. So we're talking about a ratio. This ratio is giving us some information, that information being, can we cover those short-term debts, the current debts, the debts that are going to be due within a year with the most liquid assets, those assets that are closest to cash? For example, if we take a look at a balance sheet, we can see that we have the assets on the left-hand side, and those are broken out between the current assets and the long-term or property, plant, and equipment in this case. Liabilities and equity on the right-hand side, liabilities broken out between current and long-term. We only have current in this case, meaning they're going to be due within a year. We are concentrating on not just the current assets, but the quick assets, meaning we're even limiting the more liquid assets, current assets being more liquid assets, more liquid than the long-term property, plant, and equipment. We're even limiting that down to, in this case, cash and receivables. We're not including the inventory, which we do expect to transfer, hopefully, to cash at a fairly short amount of time. But we're going to limit it to just, in this case, the cash and the receivables, the quick assets that are in this example. Compare that to the current liabilities, the things that are due within the year's time period. Then we can do our calculations. So let's put a worksheet out here. Quick ratio equals the quick assets divided by current liabilities, which in this case would be the 150 plus the 76,000 for the quick assets of 226,000 divided by the current liabilities, in this case being that 15,000. If we divide that out, then we're saying that we could pay 15 times the current liabilities with only what is in the quick assets. So this current liabilities that are going to be due within the next year, we can pay 15 times over in this case and still be pretty good. So we're feeling pretty good in this case that we'll be able to pay our current obligations.